Yeah, we're ready.
Good company, strong management, uncertain future. Good afternoon and welcome. Firstly, I'd like to thank the judges and the audience for coming out today. We really do appreciate it. My name is Nirmal Patel, and I represent the University of Waikato, alongside my team, consisting of Benji, Ivy, Andre, and Rhys. The following components make up the agenda for the rest of the presentation. Today, we are here to talk to you about Fletcher Buildings. This is a stock of a great company that has delivered outstanding results year in and year out. However, recently, it has become evident that Fletcher has been struggling to an extent that has made investors really question Fletcher's current operations. Is this the type of stock you really want to invest in? Currently listed as the second largest company in the NZX 50, flaws in Fletcher have slowly started to be exposed to the current market situation, and the dominance that once existed amongst its competitors has also come into question. However, even after delivering such mediocre results, we are still telling you to hold. We base our whole recommendation on a 12-month target price of $6.65, compared to the current price, as of today actually, of $7.26. This represents a downside of 8.4%. We justify our whole recommendation on the basis that we believe there is a current imbalance between the investment highlights and the investment risks. There are 5 key drivers that validate our whole recommendation. 1. Slow growth rate. 2. Fluctuating construction activity. 3. The faltering global economy. 4. Stable but increasing dividend yields. And 5. The competent Fletcher's management team. It is after analysing these 5 key drivers and the associated investment risks that you will be able to understand why we believe Fletcher is not as good as it makes out. Next, Benji will take you through our views of the business and our basis for the whole recommendation.
Thank you very much, Nirmal. Essentially, we have justified our whole recommendation by looking at the positive aspects that will drive Fletcher's future growth and balancing them against the negative aspects. Overall, we've identified that the negative aspects slightly outweigh the positive aspects, and thus our weak hold recommendation. So firstly today, I'll go through the positive aspects and then I'll finish off with the negatives. So firstly, recently Fletcher has managed to secure several very lucrative and very large new construction contracts. Fletcher recently won the right to construct the new $300 million Wiri prison in South Auckland. As well as this, Fletcher should bring in a further $400 million from the Waterview connection, also in Auckland. As well as this, Fletcher looking likely to construct the new Sky City Convention Centre, bringing in a further $350 million. The combined total of this construction should be a further $1 billion in revenue for Fletcher in the near future. Secondly, Fletcher are due to have a very significant role in the rebuild of Christchurch. Thus far, around $30 billion has been earmarked to rebuild the stricken city. Of this money, Fletcher should see a large proportion, having already repaired over 22,000 homes in the city. Thirdly, Fletcher is buoyed by a strong management team, with a great track record of returning consistently growing profits. In July 2012, Mark Adamson took the reins as CEO. My team and I see this as a very positive move indeed, as Adamson comes from the laminates division with a great track record in returning consistently growing profits. However, in spite of these positive aspects, there's some very, very significant negative aspects which will constrict Fletcher's future price viability. The most important of which is the faltering world economy. Over the past few quarters, we have seen world GDP growth stutter, mainly caused by the sovereign debt crises in America and Europe. World trade has fallen 30% since 2010. This will have a huge impact on Fletcher's export markets, mainly for the building materials. As well as this, the New Zealand and Australian property markets are inherently very risky and exceptionally volatile. A vivid illustration of this can be seen when comparing building consents, the 2012 building consents in New Zealand to 2007 figures, which have dropped 21%. Overall, we can see that the negative aspects do slightly outweigh the positive aspects, and thus our weak hold recommendation. Fletcher is a good company with a strong management system, but has an uncertain future, and thus our hold recommendation. I'll now pass it to Ivy, who will go through our financials.
Thanks, Benji. Now let's take a look at the financial analysis of Fletcher Building. Total revenue of Fletcher has increased by 20%, driven mainly by its new division Crane, which contributed 106 million earnings. However, 5 of 7 divisions in Fletcher indicated an earnings decline. The most profitable division, Lemonades and Pedals, earning fall by 39% and steel fall by 42%, which significantly impact their profit contribution to Fletcher as a whole. This is due to the lower demand in the international market, which is expected to continue. Therefore, we project in the future, the sales will be increasing, but at a diminishing rate of 2.84%. Looking at the balance sheet of Fletcher Building, the gearing ratio is expected to grow at 0.95% annually for the next 5 years. This is based on the management intention to keep the gearing ratio at the lower range of 40% to 50%. If we look at the dividends for Fletcher Building, the actual dividend payout ratio is higher than the indicated 50%. To an extent, in 2012, 109% of the net income will pay out as dividend. Even in the loss-making year of 2009, Fletcher Building still managed to pay out a steady dividend. Therefore, we project in the future, the dividend payout ratio will be at a 70% or more. Now I will pass on to Andre for the valuation summary.
Thank you, Ivy. Fletcher Building is currently trading at a premium since its EV to EBITDA multiple of 8 times is higher than its peers at 7.5 times. We feel that this is unjustified as its EBITDA margin is lower in comparison to its peers. In valuing Fletcher, we went with 2 approaches. The first was discounted cash flow valuation, which valued Fletcher at $7.28, internal growth rate of 6.7% and a WACC of 11.8%. The second valuation we used was the company's comparables approach, where we use our peers' EBITDA multiple of 7.5 times, we multiply that to our 2017 forecasted EBITDA. This yielded a share price of $5.27. We confirmed our multiples analysis with a revenue multiple model share price of $5.33 and a P implied share price of $5.97. This confirms our recommendation that Fletcher Building is indeed overvalued. So, in summary, we weighted DCF and comparables at 70-30 respectively, which give us a value of $6.68. However, taking into account recent price movements, we noticed a technical support line at $6.65, and therefore established $6.65 as our ultimate price target. To quantify the risk, we ran a sensitivity analysis on both the EBITDA multiple and growth rates, and as you can observe, a hold recommendation is most appropriate given its highest probability and fairly normal distribution. Rhys will now talk you through the investment risk.
Thank you, Andre. Foreign construction rules in New Zealand has been problematic for Fletcher Building, with building consents and value decreasing since 2008. Furthermore, from July 2012 to the end of June, building consents have fallen 1.8% across New Zealand, with Auckland and Wellington being the main culprits. However, Christchurch has been supplementing falling construction levels, but is problematic for Fletcher's because slower than usual progress in Christchurch has halted progress, with 3 main reasons being this: uncertainty regarding seismic activity, the availability of long-term insurance, and the current demolition work still taking place in the central business district. Australia needs marked improvements in its construction sector, which fell for the 12th consecutive month. This is problematic for Fletcher's, as they currently have 47% of revenues derive from Australia. Global construction is in line to pick up in the next few years, and is in line with the global GDP growth rate of 3.5% until 2020, which is likely to stimulate the Laminates division. In conclusion, based on our recommendation and our analysis and our tagline, good management, strong company, uncertain future, the University of Waikato recommends a hold at a target price of $6.65 for Fletcher Building. Now, who's the first